Hello, good day. In today's lecture, we are going to talk about the behavior of interest rates. You know that interest rates actually vary, and we actually find always these interest rates keep changing. In this particular lecture, we are going to look at that what actually determines the interest rates and why these interest rates vary and why the interest rates fluctuate in the economy. For that purpose, we are going to learn about the determination of the interest rate in the first place. And we are going to look at that what actually are the determinants of the interest rates in an economy. And if you somehow know the determinants of all the assets, which actually determine the price of assets and the interest rates in the economy, you can somehow understand that what kind of fluctuations actually bring what kind of change into the interest rates. In this particular lecture, we are actually going to look at how the overall nominal interest rates are determined and why they fluctuate. To actually understand the interest rates, we are actually trying to understand the underlying assets that basically have the price in terms of the interest rates. Like say, for example, the bond for this particular purpose, we are going to use the basic relationship between the price of the bond and the interest rates on the bond. As you know, that the price of a bond and the interest rates on the bond are negatively relative. If you know that, like the price of a bond increases, the interest rates on the bond decreases, and that is true generally for the discount bonds. So what actually is a trick here? The trick here is that if you somehow know how the price of the bond is determined and why the price of the bond fluctuates, you may actually also determine the interest rate on the bond, and you can also determine that how the interest rates fluctuate. Because whenever the price actually of a bond increases, the interest rate decreases at a certain rate. And similarly, when the price of a bond decreases, the price of the interest rate increases at a certain rate. To do this, we're actually going to use the supply and demand mechanism, a very simple kind of mechanism that is used for different kind of analysis and determination of prices. Before going into that particular kind of analysis, we need to understand the definition of asset. Asset actually has got some kind of property, like the basic property of the asset is that it is used as a store of value. Whenever you have an asset, it actually is a store of value, like you can just keep that asset for a certain period of time. And when the need arises, you just convert them into cash. And that cash is basically stored into that asset. Like, say, for example, people own buildings, people own bonds, people own stock, land, houses, and they're all basically are the assets. These assets basically are used as store of value. Like, say, for example, if you buy gold and you just keep gold for a certain period of time, just want to keep your value intact. And this value is saved in the form of gold, or that gold is an asset actually. Facing the question of whether to buy and hold an asset or whether to buy one asset rather than another assets depend on a lot of factors. Like, say, for example, the very important factors are the wealth of an individual. Like, say, for example, how much asset you demand does not depend on, only the one other factor. Like, say, for example, it also depends on the wealth. The total resources owned by individuals, whenever you have got more resources, you actually can buy more assets. If you have got less resources, you can buy less assets. Similarly, another determinants of holding and buying and not buying the asset is the expected return. Whenever you buy an asset, like you always look at what actually return are you expecting from it, what kind of return, and what kind of cash flows are going to this asset is going to generate. This expected return on one asset relative to alternative assets span determines that whether you should be demanding that asset or not. Like say, for example, if the shares of a company basically are more rewarding in terms of the returns than some other kind of a bond and some other kind of assets, you go for buying the shares. Similarly, if one bond is more productive in terms of returns than the other bond, you would go for that. Another factor that determines the demand of an asset, and that change when this particular factor changes, of course, the demand for the asset changes also. Like say, for example, the risk. As you know, the risk is basically the fluctuations of the return, the standard deviations of the return. Whenever an asset becomes risky, say, for example, if you're buying a share in the market, and if the market in your country is volatile, you will be not interested so much in buying the shares because there will be a likelihood that you will be losing your money. And this money can be lost because of the fluctuations in the stock market. So the increase in risk basically make the asset more valuable or less valuable or more attractive or less attractive for the people. So the third factor that you consider for buying an asset or not buying an asset or changing the demand of asset is the risk. The third, actually the factor that determines the demand for an asset is the liquidity. How quickly you can convert an asset into cash. Like say, for example, those assets are not demanded in the market, which are not liquid, which cannot be converted into cash. Like say, for example, there are such assets for which the secondary markets do not exist. And even if the secondary markets exist, they are not very popular. So that's what basically determines, like, say, for example, these all factors are the factors that determine the demand of an asset. And not only they determine the demand of an asset, but they also determine that why the demand sometimes changes. Like, say, for example, some assets are more demand, they come in more demand. And that actually happens because their expected return relative to other assets increases. Similarly, that some actually assets become less riskier than the others. So that basically also increases the demand for the assets. And similarly, the liquidity. If one asset's liquidity increases in terms of or in against of the other assets, it becomes more popular. This particular lecture will be continued in the next video, and we shall be learning about the actual demand and supply curves, and we'll see how the price is determined. And once we know that how the price is determined, we will be seeing how this price fluctuates. And from that price, we shall be driving the value for the interest rates. Thank you for joining us.